Welcome back to Quant Forge. On this channel, we test trading strategies with real data, real Python code, and real backtests. No magic indicators, no secret algorithms discovered by hedge fund monks in Switzerland, and no Lamborghini thumbnails designed by emotionally unstable marketers. Today, we are testing something surprisingly weird. Does Bitcoin actually make money during normal stock market hours? Or does most of the return happen when traditional finance people are asleep? Because Bitcoin trades 24/7, but humans unfortunately do not. So we split Bitcoin returns into two categories: NYSE trading hours and everything outside them, which includes nights, weekends, and the deeply concerning hours where crypto traders begin explaining macroeconomics on social media. First, we load the Bitcoin data, hourly prices, nothing fancy yet. At this point, every strategy still looks intelligent. Then we define NYSE trading hours, 9:30 a.m. to 4 p.m. New York time. Very official, very regulated, very capable of underperforming Bitcoin. Next, we calculate hourly returns. Then we separate them into three equity curves: buy and hold, NYSE hours only, and outside NYSE hours. Simple idea, very clean test. Minimal opportunity for us to accidentally create statistical fiction. Now here's the chart, and immediately something looks strange. The cyan line is buy and hold, pure Bitcoin exposure, maximum volatility, maximum emotional damage. The yellow line is NYSE hours only, which appears to spend most of its life wandering sideways with tremendous confidence. Meanwhile, the purple line outside NYSE hours does most of the actual work, most of the gains, most of the trend, most of the movement, which is fascinating because if this holds up, Bitcoin may not really care about traditional market hours at all. In fact, the market seems to perform best when traditional finance people are theoretically offline, pretending to enjoy dinner. And now let's look at the numbers. Buy and hold returned roughly 32%. Outside NYSE hours returned around 27%. NYSE hours only returned 4%, which is technically positive. Spiritually, however, this resembles a savings account experiencing burnout. Volatility during NYSE hours was lower, drawdowns were smaller, the experience was calmer, but unfortunately, so were the returns. Outside NYSE hours captured most of the upside, most of the chaos, and most of the actual profit, which suggests that Bitcoin's edge may come from periods where institutional participation is weaker or possibly unconscious. Now obviously this is not a complete trading strategy. There are no fees, no slippage, no leverage, no execution constraints, and no fake 98% win rate discovered after 12 hours of parameter optimization and a mild psychological collapse. This is just return decomposition, but the difference is still large enough to matter. So the conclusion is surprisingly simple. If you only held Bitcoin during NYSE hours, you missed most of the move, which means Bitcoin continues behaving less like a traditional financial asset and more like a globally distributed insomnia engine.